Hi, I'm Terrell Turner, the host of the Business Talk Library, and today I thought it would be great to bring on a special guest, someone that that is in the industry of working with funds as a fund controller. And I thought it was interesting because we can talk about what a fund controller does, and then one of the very big things as a fund, they are in the business of taking investor money and investing in other businesses. So that is critical if you're an entrepreneur or a business leader and you're trying to understand, hey, whether I want to raise capital or whether I want to, do an exit for my business. So welcome to the show, Kyle.
Hey, thanks for having me.
Absolutely. Now, Kyle, before we jump into kind of your current role of or your experience as a fund controller, what was your background before you came into a fund controller role?
Sure. So I'll start from the beginning. I started off in mutual fund accounting. So finance world well, it's gotten much more complicated. But in a nutshell, we can say that the finance world, in terms of investing, is broken up into mutual funds, hedge funds, and PE funds, basically. Mutual funds, a lot of time are looked at as plain vanilla. They usually have a mandate and they stick to that mandate. So that mandate might be buying certain companies within the S&P. It might be buying a certain industry, and they kind of stick to it. They're kind of beholden to the prospectus. So that's the world I started in, and I need to caveat it. I started off in mutual funds, but it was as a mutual fund administrator. So these are outsourced companies that worked for the mutual fund. Um, the first half of my career, I would say I was at all administrators. So I started as a mutual fund accountant for an administrator, a major administrator in the Boston area. My degree was it was a finance major with an accounting minor, my initial degree. Um, and so I took that role. I remember taking a class actually called mutual fund accounting, was one of my last accounting courses. And from there, I got a role. I was able to land a job as a mutual fund administrator in Boston. I did that job for maybe 8, 9 months, rose up pretty quickly. So I jumped from accountant to senior accountant within those 8 months. But when you're working in mutual fund administration, you're always looking for the next thing. And the next thing, if you're in mutual funds, is hedge funds. So I got a call out of the blue from a recruiter in the New York area. And I believe this was around 2007 or 2008 sometime. Don't quote me on this. My years are blended in. But I think it was around 2008. Guy called me, told me about a role in hedge funds in the New York area. So I jumped at it. The pay was better. It was along the business that I wanted to get into. So I made the transition over to hedge fund administration. Now, hedge funds, they give their clients, when I say clients, it's their investors. They give their investors a basic perspectives of this is what we're going to do. These are the types of businesses we're going to buy into. And usually they're buying stocks or Forex or options, things like that. But they also put a clause in every we call it an IPA agreement, and every agreement that says basically they can do whatever they want. So they have a lot of leeway to go into many asset classes. They'll sometimes buy actual companies. They'll sometimes buy very hard to value assets. But they basically do anything they want in the finance world, most hedge funds, that is. So I worked in the hedge fund space for probably 5 to 6 years. I started off as a hedge fund administrator, and then I transitioned to an actual hedge fund working at UBS. So I worked for the unit was called A&Q, which is just alternative assets. So we worked, we would put our investors in many different hedge funds. Working at a shop like UBS, they have access to basically everyone. So we would bring our clients in who wanted access to certain hedge funds that basically wouldn't give access to anyone. So we were able to provide our clients access to other hedge funds. I worked in that space for about 5, maybe 6 years, at which point I got the opportunity to move over as a controller to my current role, which is at Ares Management. We're almost a hybrid. I want to. Some of us sometimes we have a few distinct businesses. So we have credit, real estate, and then we have direct lending. I work in what's called the direct lending business, which is we take our investors' money and we invest in, we call them medium-sized companies, U.S. companies, that is, in the form of ABL, asset-backed lending. So we'll look at a company that's been running, say, 5 years, and we'll say, okay, this company might be bringing in 10, 20, 30 million a year in revenue. But we will then say, what's that company's inventory? What's their expected cash flows? How much are we willing to give them, in essence, as a loan, based on their collateral? So I've been doing that for about 3 years now. We see quite a few different companies. Our portfolio currently consists of, well, Ares as a whole, we deal with thousands of companies. My hedge fund, we've dealt with hundreds of companies. Our portfolio it averages usually 50 to 70 different companies that we have investments in, or ABL loans at any given time. So in a nutshell, that's the business. What do I do in that business as a controller? I am basically in between accounting and the CFO. So the CFO is usually thinking high level, thinking future goals, future arrangements. My goal is to make his life easier as well as handle the accounting.
Awesome. So with an experience like that, is it fair to say that, you've had a lot of exposure to seeing I guess you say, the financial side of a ton of other companies, and like, what metrics they measure and just kind of what their trends look like?
That's true. So I want to caveat this and say that as a controller, my job is to know the finances of our business, which is the fund, right? Now, being that we hold positions in other companies, yes, I do look very often into the financials of other companies, but that is not my day-to-day job. That's more of an aside. I understand how to look at those metrics, and I do it quite often, but my main role is the business and the finances of the fund.
Gotcha. Now, so as we think about, that kind of that journey through that career path, what was it like just trying to figure out, what role you should take next or what step you should take next? Like, how'd you kind of navigate that? Was it you figured it out on your own? Did you have a mentor, or how'd you approach that?
I will say I've never had anyone that I would consider a mentor. I've always had people who have been helpful along the way, who have basically showed me how things work. To a large extent, I would classify them as friends almost. It's like you meet people who know something that you don't know, and you kind of develop a rapport. I wouldn't classify them necessarily as mentors. So a lot of it has just been doing a lot of reading, find someone who's interesting and knows something. You have a conversation with that person, you get a better perspective, a window into another world. So I won't say it's been luck, but it's been a lot of, you see where you are. Like, for instance, I started off in mutual fund administration, almost just by the fact that I took a class called mutual fund administration, right? It was literally that simple. And then once I got into that role, I started to look at the playing field. I didn't know truthfully what a hedge fund truly was until I started working as a mutual fund administrator. So I started to realize, okay, the world of finance is, there's these hedge funds things, and they seem to throw off a lot of money. They seem to do a lot of very interesting things. Got a lot of stories about some of what my older investors used to do, or sorry, my older clients used to do when I was in a hedge fund world. But you start to the light starts to come up, and you start to see, okay, this is the world I'm living in. These are the things I can do, and that's what you do. So I started off as a mutual fund administration. Sorry, I keep repeating this, but then you see the world of hedge funds. It's like, okay, I'm going to go there, and then you say, okay, I'm an administrator. I'm working for the hedge fund. I want to be at the hedge fund. So you say, okay, I want to get rid of this administration title and actually work for the fund. And I mean, that's the progression. You see a little bit more with each level you climb up, and that's how you decide to which direction you want to take. In hindsight, I say to myself, it would have been nice if I knew this world before I jumped into mutual fund administration. Might have saved myself 5 years, but but that journey was worth taking, and I learned a lot along the way.
Awesome. So now I want to talk about, as you talked about, you're knowing like your company, your funds, finances, and their accounting, and you guys are kind of in the middle of you're taking in funds to then, I guess find places to invest it or where to give loans. So when
Sure.
you're looking at, your fund, what are some of the types of metrics that you guys are paying attention to, or metrics that you're
Sure.
watching to see, hey, these are what matter?
Sure. So when it comes to our investors, there's the main metric they're looking at is IRR, and it's internal rate of return. And basically, what that is if you were to say, this is going to be very simple. So if you let's say you earn 10% over the course of 5 years, your IRR on average is like 2% a year or something like that, not including any sort of compounding. So most investors want to look at their returns from IRR perspective because it says, what did I put in as capital into this endeavor, and how much am I making back on average on a yearly basis in regards to that endeavor. So our investors want to see IRR. Now, when we're looking into investments, to where do we put their money? What do we invest in? We're looking at things like ROE, and as it relates to the actual businesses that we put their money into, first thing we're going to look at is cash flow, the amount of inventory, and we look for free cash flow. So we look for like what's their cash flow after operations. Um, we look into like their financing and things like that, obviously, but you usually want to know what is the business throwing off in terms of cash. That's the primary metric that we look at in regards to the the clients that we invest in, meaning the businesses that we invest in. So you'll hear things like EBITDA, which is close to cash, or free cash flow. Those are the metrics we look at. Now, in terms of how much money we'll give those businesses, we basically look at receivables, what's their inventory level, how much cash they have sitting on the books. Although cash tends to fluctuate, it can be there one day and not there the next day. So we're usually looking at cash flow coming in, the ROE to a smaller extent of that business, and any sort of inventory that we can have as collateral on our lending.
Okay, so now I understand those terms because my background is accounting and finance. So, but I think a lot of the audience may not. So let's dive a little bit deeper. So when you talk about, cash flow and you're looking at it from operating, financing, and investing activities. So when you say operating, meaning you're looking at, hey, outside of whatever loans or lines of credit they've gotten, is what is your operation? I guess you say the cash from the sale of your products and the normal expenses of your business. Is that what you guys talk about
That's
with
right.
operating?
We're saying don't show me the cash that your Uncle Ben invested in your business. Or don't show me the cash from that loan that you took out. We want to see the cash that you actually generate by running your business. Right? We don't want to see the cash that you got when you sold that house, or when you sold the car. We literally want to see that, just, hey, you sold X widgets. How much were the cost of selling those widgets? How much was the we want you to factor out the depreciation, because while it impacts your income, it doesn't necessarily impact your cash flow. That's what we're looking at. The true operation of the business, not what you took out as a loan, because that's cash, but it's not recurring, or not what you took out by selling an asset, Now, to a large extent, we do want to see like how much you're spending in capital, right? Because there are some businesses out there that, whereas their operating cash flow may not include the fact that they're updating their factory every month or every year, we know that those are recurring items. So sometimes we do factor in like their capital expenditures in that number. But on the whole, most businesses that we look at, we're going to say, what were your free cash flows from operations?
Mhm.
We usually ask for what is your EBITDA, but it's very close to cash flow.
Gotcha. And now, so
And for those who don't know, EBITDA would be earnings before interest, taxes, depreciation, amortization. So you're basically taking out all those things that aren't truly or not always cash.
gotcha. Now, when you guys are looking at different investments, the companies that you're looking at, is it the CFOs of those companies that you're having these discussions with, or do you guys expect like, hey, the CEO should know these backwards and forwards?
Yeah. Now I'll caveat this. I don't have these discussions. As I said, my business is the fund, right? But I do know that these conversations, when they're being done, and we call these are deals being made, they're typically taking place with a CFO who may contact one of our, we call them BDOs, business development officers, and they have direct line of sight to most businesses. So, and they have usually very long-standing relationships with these individuals. So that's usually who's going to get the first call, one of our BDOs. And they don't always, it doesn't always happen, right? We may pick up a client in many different ways, but typically it's a BDO who has a relationship with a business, typically a CEO or a CFO of that business, and they have conversations. You know? That CEO or CFO may simply reach out to say, hey, I want to take out X million of a loan from you guys, at which point we'll just go directly to their books, look at the financials, see what they have as collateral. And in some instances, we will actually take we might have an owner of a company actually like sign his collateral, sign his name as collateral, meaning like personal collateral. We don't always simply say what's the business's collateral. In some instances, we tie the owner's assets to that as well.
Gotcha.
A lot of people think you can hide through an LLC, but if you're taking funds from another business, you may be asked to put your personal collateral up as well.
Now, that's an interesting point that I think a lot of, that it talks to a lot of entrepreneurs where they say, oh, I have an LLC, like, you know, I'm fully protected. But one of those conversations I had with I guess a business broker where he was saying, you know, there are some businesses where you will have to put, you know, your personal, like your personal assets, or you may be held personally liable. Like,
Right.
other than a lease payment, are there other situations that you've seen or you've heard about where, hey, an owner may have to put themselves personally liable?
I've seen it a few times in the business that we're in, whereas someone comes in looking for a loan. We like the collateral, but the business might be somewhat risky. Is the interesting thing is that most people who are in business for a long enough period of time realize that if you're going to take funds from another entity, you got to remember we are operating in the business for our investors. So ultimately, we're working for our investors. It's our investors' capital. So we'll take funds from our investors. We will leverage those funds. We will go to a bank and say, hey, we have X amount of dollars. What's the amount you'll give us? So we'll take that new combined amount and then invest it. So we're working for our investors. We have to do right by them. We are also leveraged with another financial institution. So we have to do right by them. So we would never put the business in a situation simply because X business doesn't want to take out doesn't want to sign his personal name to a loan. We just wouldn't do that deal. If the deal were only good enough, if that owner signed his name, then he would have to sign his name, or he could find financing somewhere else if possible. But we only do deals that are to the benefit of all of our stakeholders, right? And honestly, it wouldn't be right by us to put the fund in jeopardy for that one business, because eventually, if something happened to us, which is very unlikely, he would be impacted too, right? So, so we're always thinking long term for our investors at the end of the day. And most business owners understand this. Most business owners kind of have an idea when they come looking for an investment, what's going to be required of them based on the business they're in, based on the cash flows they're generating, and based on the collateral that they have to show as to put forth as, well, collateral being collateral, based on what collateral they have to put forward. So.
Awesome. Now, as a controller, I mean, I guess, do you have other people on your team that are looking to you for leadership and guidance in the accounting space?
That's right. So we, in the same way that I used to work as an administrator, we have an outsourced administrator as well. They are basically the accounting function. So I'm speaking to those guys on a daily basis, making sure that, I mean, at the basic, that they're booking entries correctly. And then on a high level, that the reports that they're generating are accurate. our administrators, and most administrators act as what we call the books and record. So whereas I, as the controller, represent the fund, it is the administrator who represents the investor. Now the investors go through us. It's a very fine line. It's like it's almost it almost seems backwards. Whereas the investor puts their money with us, we have an administrator who's like a third party who acts as the books and records, meaning they are what they say are the financial records are the true financial records. And I am, let's put it this way, I am employed by the fund. The administrator is employed by the investor. So that's the role of our administrator / accounting team. Now we work hand in hand to come up with accounting policy. Accounting policy starts with the controller, with the CFO. We work hand in hand to make sure that all of the books and records are accurate. So they will reach out to us for guidance, and they have very deep roots as well. So our administrators will sometimes come to us with best practices and guidance. So it's a two-way street.
So what was that feeling like? I mean, when you're coming into this controller role where it's like, you are, I guess, responsible for leading a team that doesn't directly report to you. And I think that's interesting because as we see remote work evolving, and we see a lot of companies leveraging outside companies or outside contractors to where they're in that space where it's just like you're responsible for what they deliver, but they don't directly report to you.
Yeah, I always say if my administrators screw up, I'm going to take the blame. Like that's just it. So yeah, they don't report directly to me, but they understand the relationship as well. So they know that the product that we're putting out at the end of the day has to be the best. They know that if something's wrong, it's my fault, but I'm going to make sure that they don't make that mistake again. And this isn't to put my administrator. I think the guys I work with are great. We've been working together for so many years. We kind of know all of the ins and outs of the fund. So I don't expect many major mistakes at all. But it is an interesting relationship. Whereas, I mean, you hit the nail on the head. They report to me, but they are not my direct reports. I don't know. We navigate it as best we can. It's a very well-tested relationship in the financial world, whereas you have an administrator who reports to you, but actually works for the investor, but is paid by you. It's very interesting. It's very complicated, but we make it work. Mm-hmm. We all know the responsibility that we have. The administrator has to do a great job as well, because ultimately we're the ones who hire them on, even though they're working for the investor. So we hire them on. We train together. We know the problems that are going to be foreseen. We're always talking back and forth. They may as well work for us, in the sense that I talk to these guys every single day. So it's an interesting relationship, but we do the best we can. We do a good job of it.
Okay, so if I'm drawing the conclusion, well, it's, I guess, that ongoing communication, and I think just that, like I said, always being clear about what the expectations are, and just really just talking through things as they come up, or as
everything. Talking through everything, right? When we put together the audited financials at the end of every year, those guys are hip deep in it. In fact, they're the ones who actually prepare our audited financials hand in hand. So I may write all the notes that go into them, but they're the actual preparer. And like that lets you know the relationship right there. These guys are actually building the financial statements, and my job is to make sure those financial statements are 100% correct. So that lets you know how intertwined the relationship has to be. Anyone who's built a financial statement knows that like there's so much that goes into it. So in order to get it right at the end of the day, both teams have to be hip deep in it.
Gotcha. Now, before we wrap up, there's something I think that is very relevant to entrepreneurs and business leaders, is as they start to matriculate or grow through whatever path that they're on, it's having to realize, probably like you've had to, is, you're not as deep into the details as you were when you started off as an administrator. And in the early parts of your career, but having to look at things from a higher level, a higher view and perspective is, how did you get comfortable kind of letting go of some of the details and being more comfortable playing that higher view, that
Yeah.
higher perspective? How did you
It's,
navigate that journey?
as you kind of progress, I would say it's somewhat natural. So as an administrator, you're definitely, you are the details, right? And I say to so I always say to myself, I, as a controller, act as my CFO's memory to a very large extent. My administrators act as my memory to a very large extent. So you come to a way of working where you just kind of know, like, okay, this guy's role is X, my job is Y, and the other guy's role is Z, and you kind of like find those boundaries. So I know what the things that my administrators are going to remember, and I know the things that I need to remember from my higher ups, and I kind of stay there. And then every so often you kind of like jump down into the details when you have to kind of you know to to make future plans, to prepare budgets. Sometimes you have to go into the details to see how things are. But I would say the progression was very much natural. When I first started out, it was always like, as fast as you can, get the books done and try to make them right. But you knew that the senior was gonna catch everything. And now I've gotten to the point where it's like, I passed the role of senior. I'm at the role of controller. It's like I can look at most numbers and kind of, I don't want to say it's a sixth sense, but you kind of just know, like, hey, this number looks wrong, or like if sometimes an ROE might be off, and you just know the number is like needs a second look, right? Um, I would say that can only come with time. Um, I tried to count the number of reconciliations I've done over the course of my life, and the number of financials I put out. It's I can't count it because it's just a ridiculous number. Um, so you just like that time, that repetition. You get to the point where you just have an understanding of the numbers so well that you can see the issues within them before you put them out. So that's how I look at it. At a very high level, I say is the smell test, right? Does this seem right? Does it smell right? And then from there, you delve in. That's how I look at it. And then we put a lot of procedures in place, right? So I've worked with my administrative teams for so long. It's like the procedures we put in place are is like a lot of things that I crafted. Some of the things that they've helped me craft if I have an issue or want to understand something better, especially when I first started the fund, I would literally like make a procedure around it. And we've gotten to the point of working within those procedures that it's got we now know where the issues are going to arise. So we focus on those areas. So that's generally how you do it. To get comfortable with giving up day-to-day control, it just takes time, understanding your fund better than anyone, understanding the numbers better than anyone. Is like I go home and read the financials, right? So like you get to I literally read it like it's just a magazine. So when you get to that level of complacency is the wrong word, just that level of ease with the numbers, it becomes second nature to hand off control because you know where the problems or the issues are going to arise. So it's not a scary thing. And you can only get there. I've said this probably 4 times already. You can only get there with time, repetition, and maybe there's like a certain number of reconciliations you do where it's like after you hit like 500 reconciliations, just like, oh, I always say to myself, like, if I'm dealing with a complex analysis, I know instinctively that I'm going to find the answer. And it used to be like when I first started in my role, not this role, but when I first started my career, I was always afraid, what if I can't find the answer? And now it's evolved to the point where it's like, I know I'm going to find the answer. It's just a matter of how much time and what other projects I'm working on. But you only get there with time. And I would say, when did I start in this journey? I started my career in, say, 2006. So between 2006 and 2020, I gained that comfort level to say, hey, I can give up some responsibilities because I'm taking on higher responsibilities. I know those guys have been well trained, so I know they're not gonna mess up. And if they mess up, we know how to find the right answer fairly quickly.
Awesome, awesome. Well, Kyle, thank you so much for coming on. And I think that that is a very great perspective to be able to see, what does the world of business look like from a fund controller's perspective and just from the perspective of a fund, because I think that a lot of entrepreneurs and business leaders are deep in the details of their business, but being able to take an objective view to say, okay, all right, how would a potential investor or a potential funder look at my business, and what type of discussions do they have so that they can start to understand things from a different point of view. So thank you for coming on to sharing that with us.
It's my pleasure. Always good to talk with you, Joel.
Thanks for tuning in to the Business Talk Library. If you like what you heard and you want to hear more, be sure to click the subscribe button and follow us on all social media platforms as the Business Talk Library.